April was a moderately challenging month for credit trading. There was not a clear direction to the market, and there was some modest volatility. Despite that, we managed to focus on some story bonds, some quality credits, and we were able to generate a reasonably positive performance for the fund in April, which we were fairly happy with.
We think that the OECD are ultimately going to be proved right and that the bank will have to move rates higher. In the meantime, though, we've got opposing forces of global growth slowing in China, in Europe, as well as the US, against a very strong and hot housing market that are keeping the bank with their finger on the trigger of rates, but with the other eye cast in that slower growth scenario globally. So ultimately, we do think rates will go up, but in the meantime, we're going to have a fair amount of volatility in the fixed income space in Canada.
Mega actually got off to a fairly positive start, but the trading losses at JP Morgan combined with a reemergence of fears over Greece exiting the euro have really led to a fairly bearish tone. Volatility's increased, dealer bid-ask spreads have widened, so technically it's actually been a fairly poor market this month.
Well, we are seeing the sell in May phenomenon repeated yet again in the equity markets, and we're also seeing that filter into the fixed income markets, primarily due to the reasons, one of increased fears of European contagion, yet again, along with the JP Morgan story, and that has resulted in a fair amount of fear, which has pushed people away from equities into the safe havens of fixed income and bonds, but at the same time away from credit, which has widened credit spreads. So for fixed income investors, it means that you're going to see performance in the interest rate component of your bonds, but you're going to see less performance in the credit spread component of your bonds. So things like the DEX index are probably going to be reasonably healthy this month. The corporate side will be less so, and obviously equities, lots of volatility. And those types of things will probably continue until we get some sort of concrete solution out of Europe.
Our strategy this month has been generally to reduce the risk of the book, reduce our position sizes in response to the increased volatility. We've also taken steps to hedge the government to LIBOR spread, which can have an effect on credit spreads. And finally, we've made sure that our currency hedging is in place so that our returns remain consistent in Canadian dollars. What stood out for us this month is how much credit has been a much more bearish tone than even equities. Credit has had a widening on par with what it did last August, whereas equities, the fall hasn't been nearly as severe. So we really have to keep an eye on the lack of liquidity. We have to reduce our position sizes, and we really have to keep things close to home until the tone improves.
There's a real awakening for fixed income investors globally and in Canada right now that the 30-year bull run that we've seen in bonds may be at an end, but at a minimum, it's going to be difficult to continue to achieve the types of returns that we've seen during that 30-year period, and particularly in the last few years. So with that recognition comes an understanding that they need to consider the reasons that they originally invested in fixed income to preserve capital, to reduce volatility, to create some uncorrelated returns, and yet still generate income. And that's causing them to think about alternative strategies for looking at the way that they invest in fixed income, and in particular looking at a strategy like ours in the Lawrence Park Credit Strategies Fund.